Steve, what are your key takeaways this far into earnings season? And how do you think global trade-related tariffs will impact outlooks?
Well, we're still early into earnings season, although we're kind of in the thick of it now. We're not really at the halfway point yet. I think the takeaways that I'm seeing so far are this. I think companies have gotten ever increasingly skillful at managing expectations, managing their own bottom lines, and using buybacks to help those bottom lines. And if we unpack that a little bit, it's still important for companies to meet their top line number. But those top line assumptions aren't necessarily created out of thin air. There's back and forth between companies and analysts and guidance. And I think the companies have been very skillful at keeping the analysts' expectations well managed. And remember, it's not necessarily what the absolute number is, it's whether you beat whatever your expectation is tending to be more important. It was said that back in the day, Walmart would basically control the analyst to the point of view of, calling each of them up and saying, you really need to come down by a penny or two here, and then they would beat the number by a penny. I think that the analyst reforms, let's say, of the ensuing years, make that less doable. You also have the situation of GE in the old days, where I think Jack Welch had the world's biggest couch cushions in GE Capital, and he can always manage to find a penny or two hiding in those couch cushions, until that all unraveled. I think now it's just more skillful on both sides. I think the analysts know not to overshoot with their estimates, because they don't want to be wrong in either direction. I think it's ultimately, I think you're better off being a bit conservative than being a bit aggressive, because certainly you certainly don't. If you've got investors following you, you don't really want to be so beating the drum for earnings that can't be matched. That then what would happen would be you'd get the nice run up, your customers would make money, and then they'd lose money if the company doesn't beat it. It's much more sensible to have relatively conservative estimates, tell your thesis, and then if the company beats by a couple of pennies, then your customers are even happier because the stock does nicely. Another thing about playing individual earnings is they're difficult to predict. There's so many esoteric factors. But again, I think it really comes down to company performance at the top and bottom line. The top line tends to be good because we are seeing a good economy. The buybacks definitely, the buybacks help in the sense that if you're talking about earnings per share and you're reducing the per share, which is the denominator in that equation, that's one way to keep your numbers healthy. So all that I think is added up. Going forward, it's going to be tricky to see what they say about the tariffs. We really haven't seen them kick in. They have in certain industries, and you saw Harley Davidson make a lot of noise about that, this week and prior. But it's a factor out there, and companies always like to have something to blame their shortfalls on. The standard joke is they'll blame it on the weather. That's not really the case here. The tariffs are way, way, way more important than weather. But they're very esoteric, and they haven't really kicked in. And that's going to be an overhang, because I don't really think we know how they're going to impact earnings in the long run.